So why don't we get started? We'll have some people will trickle in as we come. So hello everyone. My name is Parok. It's good to see everyone. I wanted to. This is our virtual professional speaker series. So we've been doing this virtually for the last few months. Judith is our organizer, our fearless organizer of our professional speaker series. And today we're delighted to have our old friend and colleague Chad Burgess to speak to us about early stage innovation. I'll tell you a little bit about Chad. I met Chad I think 2 years ago when he was speaking at Startup Grind. He came here a few years ago to speak at the Stella Hotel. And Chad is an Aggie. He's a big fan of A&M. He graduated from the ag school. So he puts the A in A&M. And so Chad went to the Army afterwards. He served in Afghanistan and Germany. He worked for John Deere, managing many people who were making parts for tractors. He then moved to New York City, and he received his MBA from NYU. And he worked there also when he started Quake Capital while he was a student, and then afterwards co-founded Quake Capital, which eventually has moved to all over the U.S. Really. He's the co-founder and general partner of Quake. And since then, he'll probably tell you, I haven't kept up with what he's done since then, but he'll probably tell you. Today, he's here to just talk to us a little bit about his experience in entrepreneurship and innovation. One thing I've for those of you who are sort of new to the series, what the center does is to try to supplement the curriculum that we have in our classrooms with real practical knowledge from people like Chad who have worked in the trenches. And so, Chad, it's a pleasure to have you here, and feel free to speak as long as you like, and we'll just open up the Q&A towards the end. And I think it's fine if people have questions, they can just unmute themselves and just start asking questions when necessary. So Chad, welcome.
All right. Well, thank you. Can everybody hear me okay? All right. I see some heads nodding. Yeah, thanks, Croak. Thanks, Judith, for putting all this stuff together. Y'all are great. Yeah, so I'll go ahead and kick it off. Just kind of walk through some investment innovation for early stage companies. Anytime you guys want to jump in and ask some questions, please feel free to do so. I'm going to start pretty high level and then kind of drill down a little bit deeper. So there we go. So here's the agenda. So we'll cover a little bit of traditional finance, really looking at briefly looking at how it used to be done really in the turn of the century, industrialization, going to modern early stage financial markets, all the way through closing observations and questions. I'm not going to insult your intelligence. You all can read, so I'll let you go yourself. So looking at traditional finance, it's my belief it got lazy. So actually I was up in New York. I was wire transferring some money to some of the companies that we had invested in. And I was just sitting in this Wells Fargo for like hours. You know, I'm like a small venture capital fund. They don't really care too much. I'm a tiny client, so I'm good to wait there for a while. And looking on the walls, there's this Wells Fargo in Soho. There were pictures of the area, and like right down the street, General Electric was really started, and you know, the wars between Edison and Tesla were right there. And I saw these other pictures, you know, and you know, if you look to the left, you see this guy in a factory, right? Like that's a business, and that costs a lot of money for all those physical products. So, you know, in the past, we've developed our financial system based off debt, and being able to collateralize the loan in case there's a chance of default. So we had all these corner banks everywhere, you know, supporting early companies, right? Because they were all kind of the same. And so, you know, that Wells Fargo obviously scaled out along with other banks. And, you know, these things were really needed for new business loans. But I started realizing that these banks really don't do anything anymore for any of the new companies we're investing in. You know, they want 2-3 years of cash history, profitability. It's pretty stringent to get a loan from them. So like, where does somebody that wants to start a company go if you can't collateralize lines of code or any of these other things if the company fails? So these big banks, to their credit, I mean, you operationalize things and you make things simpler because you can make a lot more money that way as you operationalize. But what ends up happening is you're not inventing new methodologies of investment. And there's a lot of standardization. So there's really not much looking at any kind of future innovation. So that's kind of a brief history there. Now going into like modern early stage financial markets, I'm primarily focusing just on venture capital, specifically like up to Series A. Now, if you look at my screen, now this isn't to scale, so people, don't freak out over here. But if you look at pre-seed, seed, and seed stage companies, risk decreases, valuation increases, and company maturity has this graph. Can you see my my pointer, Croak? Okay. Yeah, and so this company maturity, looking at cash flows, obviously it's debt or not debt. You're losing money. You're having your burn rate go up until you reach profitability. Then somewhere in here, Series A, Series B, a lot of times now IPO, companies might actually become profitable and actually start making money. But for me and where Quake was, we were trying to invest in this area, this pre-seed area. So you can see risk is very high, valuation is really low, and we're not going to see any kind of cash flows for the company a lot of times until, further out in the future. All right. So did I cover everything there? Looks like I did. So I'll go into the next slide and talk about kind of the early stage venture fund mechanics and some of the challenges and the things that we do. So when you're looking at an early stage venture fund, you want to look at investment velocity and scale. So how many deals are you doing and how much money or AUM can you have and reasonably deploy over a period of time? So if you look at large hedge funds, oil and gas industry, any other kind of fund that is structured off the traditional private equity model, you're going to have this 2 and 20 model. So, 2% you're getting paid a management fee, and then 20% that's the carried interest you're paid. So a lot of venture capital funds are done off this model. The only problem with that is the smaller ones. Say if you're managing $5 or $10 million, what's the operational capital that you're getting from the management fee if it's 2% of 10 million? It's not very much, right? And that kind of brings me to the problem of early stage venture funds, where a lot of them don't exist, is they're extremely hands-on. So you have a lot of you generally have a lot of employees for very little capital that you're actually investing. So the 2% model off of the 5 million AUM, when you might have 5 to 10 employees, doesn't really work. So the innovation in this model, really going to clawbacks, was, I think, the first one we saw. And you probably give that to Y Combinator 500 startups. They invest 150,000 and then they take back 20 or $30,000 of that money. Their limited partners get full equity percentage in it. And then it's actually the companies paying a consulting fee back to the operations of the fund in order to pay salaries. Now with this, there's conflicts of interest, right? And actually with all these, there are. The vast majority of limited partners I talk to, they dislike management fees, but they get really angry about it when they're going up 2%, 3%, even sometimes for some of these funds. Basically, with a large enough fund, there's not a big enough incentive Um, on the carried interest side, so to be profitable and make good investments, when you're collecting a 2% management fee on, I don't know, a $20 billion fund, and you have 5 people working the fund. So going to clawbacks, the conflicts of interest there is really the investment velocity. So there's I guess, kind of a moral hazard where you might make too many investments just so you get that clawback. So you might not do the proper diligence. You might cut a lot of corners, and you might shoe in some deals that really should not even be a part of an accelerator or something like that, just so you can get that $30,000 clawback. The other portion is sponsorships. And I guess if you look at Techstars, they've done a great job of this as far as raising sponsorships, but there's also conflicts of interest there. These sponsors generally want something out of it. So if, I don't know, not so much like the service providers, because, Amazon Web Services, TriNet, these other companies, they might sponsor an accelerator and give that accelerator money, but just want access to the entrepreneurs, so entrepreneurs become clients for them. But say if it's a Techstars accelerator and it's sponsored by Disney, and Techstars is investing money from limited partners, Disney might want to acquire those same companies. So it's in Disney's interest to push valuation down so they get a cheap price on a company, and it's in the LP's interest to push valuation up so they get the highest return possible. So that's potential conflicts. Now you can navigate these, but they're pretty difficult to do. And then exit horizon, especially for early stage ventures. Traditionally looking at a Series A fund, you might have 5 to 10 years, average 7 for exit. That's what people are shooting for. But when you're going early stage, it's even earlier. So you're looking at, I don't know, 7 years if you're really lucky, 12 years if you're doing pretty good. And what that ends up doing is it puts your limited partnership investors at risk because they have a lot of money tied up in this fund. I can't just go to the startup and say, hey, I need my money back, like you can do in a hedge fund. It's tied up and it's put to work. So they're going to have to go at it for 7 to 12 years. Some of the people I've talked to about this, other investors, they highly suggest talking to your limited partners, tell them to be prepared to invest not only in your first fund, but your second and third as well until exits start happening and you can actually get some return back to these investors and then you can put back in your fund. All right, so going on, my screen here. So a lot of these early stage accelerators, but how they really should make their bread and butter. And yeah, you can invest in great companies and good entrepreneurs. They're going to figure stuff out, and a lot of times they're going to be successful no matter what. But you can help amplify those startups. You can help them grow. You can help them move a little bit faster, raise more money, and make their life a little bit simpler. So when you look at kind of the operations and what you have to do as far as running one of these accelerators is, and I guess this kind of differentiates, a traditional bank giving loans versus an early stage investor and venture capital is, you're working 12, 14 hours a day with these companies trying to help them out, leveraging your network, making introductions, all those things. Making sales calls for some of these companies, help find and really product out there. Looking at opportunities, knowing other funds, one, they could be deal flow for them, and then you can also diversify your risk, take a little bit of that workload off by investing side by side funds. In the early stage venture capital area, there's a lot of deal flow and not much capital or competition in terms of the capital providing. But there is a lot of competition between early stage companies for money. Just tells you there's kind of a gap in this market, and as previously stated. Also looking at what we helped with these companies, a lot of them are first-time entrepreneurs hiring individuals and sometimes having to fire or help them go through legal materials and marketing materials. And then also, a lot of these guys and gals are pretty young, so helping them find proper mentors. All right. So these are the typical investment instruments that are used in venture capital and early stage. There's equity instruments. Every once in a while, we'll come across some of these where a company just issued equity, and they're actually raising a proper Series A, and they're actually issuing shares. The problem with this is, especially for early stage companies, is they don't have a whole lot of capital, and legal fees are generally pretty high to actually do this. There's actually a lot more attention needed to the legal documents. So a correction to this, and something that's helpful, is in the past, a lot of times people use debt instruments. So this is your convertible notes. A lot of people are familiar with them. Generally have some sort of interest rate on them, and investor can collect on that interest rate at maturity, or the company fails, or they take actual equity into the company. Working capital loans. This is actually a pretty new vehicle that started popping up over the last 4, 5, 6 years. And it's really good for hardware companies, innovative CPG companies, really any company that has any kind of inventory. As far as cash flows go in your startup, a lot of that money and capital is tied up on the shelves. You got to ship product, and you have to have inventory there. You might have to pay somebody else to produce it, so your capital's tied up for a while until you can actually collect on that money. Then also looking at the KISS and SAFE instruments, they're neither debt or equity, actually. They eventually convert into equity, but they're neither. And the reason for this is really like there's massive tax advantages this way, and it for the limited partners. So you're getting in early, and then when it goes and raises a Series A, the company converts, instead of being taxed on the gains that you would get later down the road, like you're not taxed at all on it, because the equity's issued later and you pre-bought it. And then also a big advantage of it is legal fees. There's blanket documents. You can find them on Y Combinator's website, 500 Startups website. You can download these. You just fill in your company's name, and I think a couple other portions of valuation, capital, other things, and they're ready to go. And these are well known, so a lot of people use these, and they're well documented. A lot of questions I get, decided to cover it here, is just valuation methodologies, especially for early stage. It's, looking at traditional valuation methods, you have your discounted cash flow, and that's great. It works really well, if you're Coca-Cola, and you have stable cash flows, and you can understand risk. You can, derive some sort of beta. Anything, and it's actually pretty good and can be used for even Series A, Series B type startups to a certain extent. You just increase your beta and the risk for it, and 50% or so, and and discount it from there. Also in Series A, Series B, there's comps multiples. Sometimes it's just 2 times top line revenue. So it makes it pretty simple with rules of thumb in those later stages, when you actually have some sort of balance sheet and income statement and some sort of something on paper to show. But generally in the early stages, they're either pre-revenue or there's very little revenue to really go off of and decide on a valuation. So what we ended up doing is we look at several thousand deals. And as you go through those several thousand deals, you develop some sort of natural intuition for what the market's telling you, what a lot of these people they want in exchange for their company. And so as you kind of go through this, and I know it's probably not a good answer, especially for research purposes in academia, because you're not actually using strong metrics on it, but more intuition. But as you look at enough deals, you understand, okay, this deal's worth, this company can be $2 or $3 million, $4 million. But overall, at the end of the day, it's more of a negotiation and an agreement between the startup and the venture capital investor of what the valuation is, and both parties have to be pretty comfortable with it and happy with it. That's ultimately what you want, is that, because really early stages, you don't want to get hung up too much on valuations. Now, you don't want to overpay, but more than likely the company is going to fail anyhow. Going into criteria, just hitting on this a little bit, just some of the information we use, just based on what was provided by the company, understanding the founders, and kind of gathering all this data in spreadsheets, and looking at them side by side with some of these companies gives us a better idea of the maturity of the company and the valuation. We also might look at sector, CPG, those companies, especially for a startup, you want at least 50% margins, and that's hard to do. A lot of them are 20% or so. So that's just one example. Also, looking at software, that should be around 90% margins, and so that will increase the valuation as well. Another criteria, probably the most important one down here, is traction. Especially if you don't know the founders and the founders don't have any kind of track record of success. Their track records in their company, how many types of traction could be anything from like number of daily active users to amount of revenue that came in to monthly active users, number of sponsors, etc., or partnerships, things like that. So there's a lot of ways to look at traction. It's just, again, it's pretty subjective. It can be when it's not dollars and cents. Now going into team, you might look at some of the teams that are older. They might not older, but more experienced, have a better probability of success based off their network and what they've done in the past. If you look at the team and they've actually worked in the industry before, a lot of times they're actually correcting for a real problem that exists. One of the problems I see a lot with entrepreneurs is they're creating a problem, or they're solving a problem that doesn't exist. They might not have worked in the industry before, and they think this problem exists, and so they'll try to solve it and design a company around it. Being an Aggie and an ag business guy, I always found it pretty funny, a lot of people trying to solve for agricultural problems that really just don't exist, or a John Deere tractors can do 10 times better. So kind of that familiarization with the market. And then also syndication. You might want to look at the investors that have put money in before. If they're a reputable investor, that tells you something. And that means, me as a syndicate partner, my life's going to be a little bit easier because I know I have a good co-investor into this company that will help them along as well. All right. And sorry, guys, that was really short. I burned through that. We're about 25 minutes in right now. I was hoping we'd have some questions and go over some things. So, you guys want to ask any questions? Happy to cover whatever.
Hey, Chad, I thought I could just get it started. Could you tell us a little bit about your experience at founding Quake and how that was and what was that like, and a little bit about that early stage, kind of the qualitative features of early stage startup investing?
Yeah. So starting a fund from nothing, and especially when you're an accelerator and you're trying to market yourself as somebody that can help a business succeed, um, it's pretty difficult going from like nothing at all. Literally, so I was at NYU at the time, and is me and another guy in a basement, really working for nearly a year, calling around trying to figure out um, investors, trying to figure out like who will actually invest in this fund, going around and actually pitching to those investors. A lot of no's, expect, 9 no's for every 1 yes. And it's draining too, because you have to raise a certain amount of capital in order to close your fund. And if you're doing it full time, you're kind of burning through your own personal cash. So it can be, it's pretty risky and it can be pretty scary. Um, just that kind of financial instability there. But as the ball gets rolling, as you kind of make little wins every day, that's one thing we always try to strive for, to keep motivation up, is focus on the small wins, and really like pat yourself on the back for those, because it can be pretty stressful when there's a lot of no's out there. Yeah, I mean, I could cover more specifics. I don't know how long you want me to ramble on that.
And what about, I guess, the landscape of how would you compare angel investing versus micro VCs versus incubators and accelerators? Could you tell us a little bit about the differences?
Yeah, so starting with angel investors, you kind of never know what you're going to get. Now that there's some big name angel investors out there that have done pretty well. But my experience with them, for the most part, is they're groups of people that have a decent amount of money. They'll usually put, no more, from what I've seen, about 50,000 in, and you have to do a ton of diligence with them. It takes a few months, at least, sometimes years, to get money out of them, and it can be a real time suck. And if you get the wrong investor, they can continue to be a time suck, because they can constantly bother you for stuff as you're trying to run your company. And you already have enough on your plate. You're already low on personnel, and you don't have a whole lot of money. So yeah, that's kind of the angel groups. There are some good ones out there, but for the most part, I would try to avoid them. A lot of times they try to take way too much equity. And if you give too much equity up at the very beginning, it's a high probability that your company is just going to fail based on the cap table alone. It's already wrecked from the beginning. Say if an angel investor takes 20% of the company, there's only 80%. If you want this company to IPO and you need to pay employees and other things, like from the start, 20% of your company's gone for some dead weight investor. That's a lot of times that's what angel groups are. But again, I caveat that there's a lot of good ones out there too. Looking at, I guess, incubators, accelerators, that term's thrown out a lot. Traditionally, incubator is probably like something you see on Silicon Valley. Company might take a little bit of your money, or a little bit of your company, maybe 1% or 2. You can sit in their place. They might, have snacks and stuff for you to munch on, and then hopefully they provide some value and some contacts and help you get up to speed with your business, and provide you with other resources than just like shelter. I can run a company out of my house. I don't need to go to some other people's place. But so that's that's kind of the incubator model. And then the true accelerator model is really investing and then having anywhere from, I don't know, 6 weeks to a few months of an accelerator where you catch a company at the point, kind of at a tipping point is where really where you want to catch them. You invest in them and then you help them grow. And we'd always say we'd want to get, a year or two of growth out of 12 weeks of working with a company. That was our qualitative metric of success. So yeah, but I wouldn't be fooled by, there's a lot of them out there that actually don't give money. They call themselves accelerators and things like this. So yeah, just really do your research on what kind of value early stage investors can provide. Yeah.
I have other questions, but I wanted to open it up. If anyone else wants to ask a question, feel free to unmute yourself.
There's one in the chat.
Oh, there is?
Yeah, do you want to go ahead and read it, Krug?
Okay, I only see your chat. I don't see the general chat. Do you want to read it?
I'll say it. Yeah, it says, speaking from the point of the entrepreneur, I was wondering if any type of investor, after they've regained their initial investment, plus some percentage of profit, they'll give up their equity. Not sure if it exists.
So are they talking about an investor selling the equity back to the company or to, is that right?
Yeah, that's what it seems like. But Michael, feel free to unmute yourself and ask and provide any clarification. But from my understanding, that is what he's referring to.
Are you there, Michael?
Oh yeah, I'm sorry. Yes, that's what I mean.
Okay. Yeah, I mean, that can be pretty common, I think. That's really between the entrepreneur and the investor. For an investor, they have a fiduciary duty to their limited partners. They have to get them the highest return possible. And you always need to be working in the interest of your limited partners, and it's actually illegal if you're not. So it really depends on the situation there where, if this is a company an entrepreneur started, it has pretty good cash flow, it probably won't get public and it's not going to get acquired by anybody else, and say the company just wants to clean up their cap table. I'd say it might be in the best interest of the investors, limited partners, to actually purchase or sell back those equity securities back to the company. Whereas if the investor believes this company is really going to grow and there's a good probability that it'll become public, they probably wouldn't do that for the entrepreneur, because again, they have to look out for the best interest of their investors.
So is there any way that the entrepreneur can forcefully buy back that equity from the investors?
So you can put it in legal writing. I haven't really heard a lot about that. Usually at the negotiation table, most of the time, the investor has the leverage. And that's just, as an investor, like, I would never really put myself at that kind of risk. I would probably just say no, and unless it's a great company, maybe go on to the next one. But I'm sure you could work with a lawyer and put that in writing, but that kind of goes back to available funds for the early stage company. There really isn't a whole lot, and you have to watch, like a hawk, how much you're really spending. You really have to keep that money under control, and lawyers can be, a cheap one will be like $200 or $300 an hour. For a pretty reputable one or good one, it could be anywhere from $700 to $1,200 an hour. So if you wanted to draw a contract or something like that up, you're looking at least, a couple hours of work. So I don't know, say, you want to pay $1,400 up front for this option that potentially most investors would likely say no to. That's the only way I could really think of, like, for sure, is just get that in the agreement before they invest.
I see. So when you initially draw up that agreement with the investors, would you not need a lawyer there present as well, or?
So you don't actually do it with them. It's not like you're kind of side by side. Usually, you would talk to their terms. You're in charge of your business. As an entrepreneur, like, it's your business. A lawyer's there to help you achieve what you're trying to achieve in your business. Like, they're a service provider, and they're going to go with whatever you want at the end of the day. So if you tell them you want these terms, they'll draw it in there. You take those terms, you send it to the venture capital investor. They'll look over those terms, and have their own lawyers look at it, and then probably kick them back for your lawyer to look at it. At the end of the day, like, there's a joke, about, like, hating lawyers. There's kind of a reason for it, because it can add up. I mean, they're expensive. Their services are needed, but they're really expensive. And if you get this back and forth going with these contracts, it can add up a lot on both sides. Now, me as an investor, and if I received one of these contracts, I'd be pretty, this is a great company, right? Like, something I'm really willing to bite on. I'd be pretty turned off by it, just because I know I'm going to have to spend, it could be $2,000 just trying to get a legal contract hammered out with $150,000 investment. So,
I see.
Yeah.
So what if you were to offer the investors a deal that's too good to be true? So after they regain their initial investment, plus maybe like another 200%, under those conditions, would the average investor be willing to sell back their equity?
I think it depends on the company. You're kind of capping your upside. And your downside's obviously capped at 0. It's something that could probably be entertained. Yeah. If you look at the KISS and the SAFE agreements, a portion of that is, if those, going back to them, they're not debt or equity, right? So they haven't converted or anything. Let's see here. Yeah. So they haven't really converted to anything, right? These KISS and SAFE instruments. But what they do have in them is, a lot of times, this happened a couple times, where a company was bought out that we had invested in, and it was before these KISS or SAFE instruments actually converted into equity into the company. And in those KISS and SAFE instruments, there's a 2 or 3 times. I think the standard SAFE now says 1.5 times investment amount that has to be paid out to those investors. Now there's kind of issues with this, right? On that exit scenario. We actually ran into this where a lot of investors invested in one company, and the company sold for, I'd say, about 2 times what they had previously invested in. And we actually ended up, we had a better deal than some of those, just based off the KISS. And we got, I think, I can't say the exact number. I don't think I should. But what ends up happening is some of those investors, they get crammed down, meaning they might actually lose money on the deal because the ownership in the company, um, it's I wish I had a spreadsheet. Sorry, I'm not too articulate on it, but the ownership in the company gets it gets crammed down so much by all the capital that was bought for that company going to the kiss and safe agreements where you're getting 2 or 3 times extra money, where all these other people, they might only get 50% back because the kiss and safe instruments actually trump those prior instruments that were used as investment. Hopefully that made sense. Sorry, I'm not a professor. I do my best trying to walk through this.
Okay, next question is, Chad, what's the best metric for entrepreneurs to use in order to show investors they have product market fit?
Revenue. Money. If people are willing to pay for it, there's some sort of value there. And not money just from one entity. It's, you want from several different entities that just don't know each other at all.
What about pre-revenue, Chad?
As far as best metrics?
Correct, like monthly active users, retention rate, daily active users.
Yeah, I mean, it really depends on the company's vertical, where they're playing. Eyeballs, if it's a social media, something like that, obviously, daily active users, monthly active users are great ways. If you're looking at something that's pretty high tech, a lot of stuff that I'll look at is non-dilutive grants these companies have gotten. If you look at that, say this, a big example of this is Army Futures Command. And a lot of the stuff the military is putting out there, a lot of grants that are given out. If a company is able to, get $1 million, $2 million in grant funding, and I'm able to invest in that company and the technology they built off those $1 million or $2 million at a pretty good valuation, that shows some, at least less risk and hopefully a higher probability of success.
Right. Okay. Thank you.
Is there any like vertical or anything in particular you're thinking of?
I mean, more along the lines of, yeah, retention rate, and I'm kind of here, me and my wife founding a company, and trying to figure out what's the best as far as, okay, like what's minimum almost of like, okay, we have 1,000 users that keep coming back every day, maybe 5,000 downloaded the app, but then there's 1,000 that keep coming back every day. Do investors see that and they're like, oh wow, that's really great, you have something? Or is it like, no, wait until you have 100,000?
Yeah, I mean, it's going to be different, right? So that Series A investor, they might want 100,000 and 100,000 daily active users. Where the early stage investor, you might have a lot fewer users, but they open up the technology platform and look at it and say, hey, these people actually built something that actually works really well. And those are early indications of success. If you have a high retention rate, yeah, that's what you look for, I guess, in, kind of more of the social media type, yeah.
Cool. Okay, no, that's super helpful. Yeah, and I think that's exactly, and we're at the absolutely stage of earlier, rather than later. So, but thank you, appreciate it.
Mm-hmm.
Chad, I wanted to actually bring the conversation a little bit more local and about Texas, and specifically about Texas A&M. So what are your thoughts about entrepreneurship innovation here in our community, especially for our students, maybe even our some undergraduates, PhD students? What are some ways that you think would work to amplify innovation in entrepreneurship here?
Yeah, I mean, I'm glad you asked this question, Karok, because we've talked about it quite a bit. um, it's it leverage the academic research that's actually happening at A&M. If you look at A&M's more of an applied science type university. It's not so much theoretical. So a lot of the money that's actually going into the research in the mechanical portion of the A&M and engineering portion, I think it's, was it like number 5 or 10 in the country out of both public and private schooling. And so at A&M, there's a ton of research going on, especially in conjunction with Army Futures Command, that research can be commercialized into companies. And rather than kind of your typical companies that I've seen a lot, it's social media, it's a new type of coffee, it's a new type of, I don't know, vegan bar or something. There's all sorts of random stuff. It's a dating app. It's just a really crowded marketplace for those things. And you're sitting at a university that's one of the most heavily capitalized in the country, and has some of the best research in the country, really in the world. That's just right under your nose. So, I'd seek out an area that really interests you, whether it's agriculture. There's all sorts of innovation in agriculture, from seed to engineering and robots, working in the fields and such, to even the nuclear energy portion of the school. I've seen some deals coming out there that are, working with nuclear waste and actually different types of nuclear filament. So I would definitely leverage the research that's there and see if there's anything you think you could commercialize and turn into a company. And if you have that, you already have a massive strategic advantage, because so much research dollars has gone into that. And there's very few people that can replicate that, because there's not too many of those brains just hanging out around the country. So yeah, I would go after something like that.
Chad, what you've been all over Texas. What are some big ideas and big themes you're seeing in Texas from your vantage point in Austin in the innovation space, say in the last year or so, or 2 years?
I mean, it's growing. It's it's growing pretty crazy. I mean, you go to Houston. There's a lot going on there with Rice, with the city, with venture capital funds, a lot of corporate venture capital partners. So you're talking about Chevron and Exxon. They're there looking for different types of energy, and they're looking to invest. You come over here, or you just go a little bit north. You're in College Station. I think there's 20 or 25,000 undergraduate engineers there. And if you want to start a company, you need engineering talent to fuel that. So that's growing there. Kind of the same out here in Austin. Venture capital is flying here. Corporate venture capital is coming here. A lot of it is because Army Futures Command, and a lot of Department of Defense type research between both A&M and the UT system. And then, going up to Dallas, you have SMU, you have Texas Instruments, University of Texas. Dallas has some of the best engineering students out there as well. So you kind of have this triangle. Oh, and not to forget San Antonio, which actually does have probably the best cybersecurity network and research done down there, besides maybe Washington D.C. I mean, they're pretty far ahead of Silicon Valley there. So there's a strategic advantage there. So yeah, I mean, I'm pretty gung ho on it. A lot of money is coming here. There's opportunity zones where there's actually massive incentives to kind of build out these companies in certain areas. So yeah, I think there's there's good times ahead in the future if you want to start your own company. Doesn't necessarily have to be a tech company, but there's a lot of activity that's blowing up right now.
And you're noticing, what are some of the things you're noticing about the Silicon Valley exodus into Austin? Is there anything specific that's how things are changing aside from
Yeah.
house prices going up?
Yeah. Yeah, no, there's, one thing that we looked at Quake is we're intentionally avoiding Silicon Valley. With venture capital, you want to be pretty close to your investments in your portfolio companies. You can talk to them, check on them, also do a little diligence and help them out in those areas. And a lot of that money was centralized to Silicon Valley. And so what we're seeing is the valuations were generally about 2 or 3 times as high, and we're looking at about half the traction. There's just so much money in that pocket. It was just driving prices up. Kind of think of it as like its own little stock market there. So when that capital left, we started looking at deals. Some of our best deals came out of Iowa. There's no capital there. It's dry. So we could actually get really good deals there. Not a whole lot of competition for them. And right now we're kind of at this tipping point in Texas. Again, especially because of the DoD. If you look at Silicon Valley, really the internet was created there via DARPA, which is a Department of Defense agency. So they created that there, and a lot of those kind of agencies are moving out here to Texas. So there's going to be a lot more technologies pushing here.
So what's next for you, Chad? What are your plans looking ahead? Any ideas?
I'm just kind of putting my feet up now.
Yeah.
Just been hanging out for a little bit. I might start another fund. I might start a company. I'm not too sure yet. Just been enjoying it. So if you guys go out there and start your own little micro VC, I'll warn you, it's a ton of work. So definitely watch out for your personal life. I was up there. I was working about 100-hour weeks. That's all I did was work, and
Right.
And it's just be prepared for it. There's seasons in life, and right now I'm kind of at a season where just putting the feet up a little bit.
So I've actually wondered why is it that it seems like all the juicy money and the juicy life is in the late stage VCs, and why is it that there isn't more competition that kind of erodes away those returns or towards something similar to what early stage VC is? Any ideas there?
Yeah, so I mean, WeWork's a really good example of this. If you look at Regis, which is the closest competitor to WeWork, I'd say. Now WeWork's a co-working space. You can go there, you pay a monthly rate, and it's kind of cool. It has cool designs. I don't know. It's a real estate company. That company was valued at about $18 per. I'm sorry, $90 per desk, whereas Regis was valued at about $5 per desk. So it's about 18 times multiple on WeWork versus Regis for some cool spray paint on the wall. And, if you're familiar with the WeWork story, it just absolutely collapsed. There was a lot of venture money backing it. And I'd say the reason that collapse, to your point, Kurok, is there really isn't a whole lot of competition in later stages. It's hard to raise a really big fund to this area, for reasons noted earlier. But if you get to the point where you can raise that fund, you can invest in pretty solid deals, ones that already have good chances of success. You're a lot more hands off, so it's probably less hours, and you can just run on that 2% management fee. You don't have to deal with all these operations where you're going, where you have high headcount. Let me see. Yeah, so this amplification focus, it's not so much any of this, right? You're helping them build their teams. On your team in a later stage fund, you might have kind of a stable of CEOs you can call up, and Series A, Series B might replace their original CEO. It's just kind of how it works. But it's a lot of these functions, you're not as hands-on with them. So you're running off the 2% management fee, so you're highly capitalized. You generally have less work. The deals are coming to you pretty vetted, and they already have a good amount of revenue and track record. You can kind of look at them based off of traditional banking metrics and evaluate them that way. And so it's just much easier to start a fund like that if you can raise that kind of capital versus the early stage micro fund where you kind of have to be crazy and stupid to do this stuff. I was really passionate about it. That's the reason I started Quake. But it's a grind, man. And that's pretty much the reason why. If you look at it, there's only there's Y Combinator and 500 startups and Techstars are really the big three that are out there. Other than that, it's just a bunch of mom and pops, kind of, even Quake's kind of a mom and pop.
Do you think the market will survive for these incubators, accelerators, the really early stage, the long term?
That's questionable. I really don't know. I think there's kind of a movement away from, I think, metrics and actually making money versus more of a charity case in a lot of this early stage investing. And I think the more you move away from sound business practices and fundamentals, the more failures you're going to get. And if you have those kind of failures and those are systemic throughout the early stage market, I think investors and limited partners will pick up on that.